Everything in this video is not a financial advice. Gold and silver have been valued for centuries as stores of wealth and symbols of stability. While they do not offer the high returns or income generation that some other investments provide, they play a unique role in a well-balanced portfolio. Let's explore why investing in gold and silver can be beneficial, their historical performance, and how they act as safeguards during uncertain times. Benefits of gold and silver investments. 1. Crisis protection. Gold and silver are often referred to as safe haven assets. 1. During periods of economic uncertainty, political instability, or currency devaluation, these precious metals can serve as a reliable store of value. 1. For example, in the event of hyperinflation or a financial collapse, having physical gold or silver can act as a hedge against the declining value of paper currency. 2. Tangible assets. Unlike stocks or bonds, gold and silver are physical assets that you can hold in your hands. 2. This tangibility can be reassuring, particularly during times when digital systems or banking infrastructure might be compromised. 3. Diversification. Adding gold and silver to your portfolio provides diversification. 3. They tend to have a low correlation with stocks and bonds, meaning their value may remain stable or even increase when other asset classes are declining. 4. Inflation hedge. Historically, gold and silver have maintained their purchasing power over the long term. 4. As the value of fiat currencies declines due to inflation, the price of these precious metals often rises, preserving wealth. Drawbacks to consider. 1. Low returns. Gold and silver generally offer lower returns compared to equities. 1. For example, gold's average annual return over the past 30 years has been approximately 5 to 6%. 1. Unlike stocks or bonds, they do not pay dividends or interest, which means they don't directly generate income. 2. Storage and security. If you choose to hold physical gold or silver, you need to consider storage and security costs, such as purchasing a safe or paying for a safety deposit box. Historical performance of gold and silver. Let's examine the growth of gold and silver over the past decades. 1. Gold, ticker symbol GLD. In 2013, gold was priced at approximately $1,600 per ounce. By 2023, its value had risen to over $2,000 per ounce, an increase of about 30% over 10 years. In 2003, gold was around $400 per ounce. Over 20 years, this represents a 400% increase. In 1993, gold was priced at roughly $3 per ounce. Over 30 years, its value has grown significantly, demonstrating its ability to preserve wealth over the long term. 2. Silver. In 2013, silver was priced around $20 per ounce. As of 2023, its value has increased to about $20 per ounce. In 2003, silver was priced at $5 per ounce. Over 20 years, it has grown by approximately 400%. So in 1993, silver's price was about $4 per ounce, showing consistent growth over 30 years. Gold as a stock investment. Investors who prefer not to hold physical gold can opt for gold-related stocks or ETFs. One popular choice is the SPDR Gold Shares ETF, ticker symbol GLD, which tracks the price of gold and offers a convenient way to invest without dealing with physical storage. Why gold and silver matter in crisis situations? Gold and silver have a unique role as insurance policies for your portfolio. In extreme scenarios, such as economic collapse or geopolitical turmoil, they can preserve purchasing power when other assets fail. For example, 1. Hyperinflation. In countries experiencing hyperinflation, gold and silver retain their value while paper money rapidly devalues. 2. Currency devaluation. If a national currency loses value against other currencies, precious metals often increase in price, preserving wealth. 3. Banking instability. During banking crises, physical gold and silver can provide liquidity when access to traditional banking systems is restricted. Long-term perspective on gold and silver. While gold and silver may not generate high returns or income, they offer stability and act as a hedge against uncertainty. They are best viewed as complementary assets rather than primary drivers of portfolio growth. A common recommendation is to allocate 5 to 10% of your portfolio to precious metals to achieve diversification and risk mitigation. Conclusion. Investing in gold and silver can be a prudent choice for those seeking to safeguard their wealth against economic uncertainties. While they may not deliver the high returns of equities or generate income, their historical performance and role as crisis-resistant assets make them valuable additions to a diversified portfolio. By considering both physical and stock-based investments like GLD, you can tailor your approach to fit your financial goals and risk tolerance. Takeaway: 1. Keep a small amount of gold and silver in your portfolio. 2. Aim for the physical bullion. If you want to get a detailed video of how to choose gold, leave a comment, like and subscribe.